The commercial real estate industry is in absolute disarray right now, as the bond market pressure is now forcing the real estate sector to confront current pricing realities. As the rise in the 10-year treasury yields drive debt costs to levels where most investors can't afford to wait for a better macroeconomic backdrop, and it's forcing them to wait. After years of inflation and stopgap measures, the rising cost of debt is forcing a reckoning for owners with commercial mortgage backed securities debt, underwritten before the Federal Reserve's tightening cycle began in 2022. The number of distressed CMBS loans has now begun to tick up again as owners and lenders agree to press ahead on resolutions rather than extensions. And the reasons why these resolutions have to be made instead of the extensions is because banks are holding this debt on their balance sheet. And if it's going unpaid, they're going to be in trouble with their shareholders, and it's going to put more pressures on their bank and their ability to borrow money to lend it out and make money. So there is an inflection point. And Michael Kaplan, president of Slight Capital, said it best that this inflection point on these deals are starting to cause owners that are refinancing properties with already tight operating income today, they're having to do it. Typically, they have only two options, right? And that is one, to compensate for the run up in interest rates. That's a really big deal because if their margins are small and they have to take on new debt at a higher rate, means their payments higher. One of the only things that they can do is try and compensate for that run up. So they got to go and charge their tenants more, or they have to try and extend the term. Michael Kaplan went on to say that the answer or their answer right now is short of coming in with more equity and right sizing of these loans is to consider giving it back, just giving the property back. And that's going to be a big deal. Hey, and I want to dip in real quick and remind everyone, today's the last day for the sale, the 80% off sale on the tax lien program. Anywhere in the country, you can invest in tax liens, doesn't matter where you live, and you can start making stupid amounts of interest by literally paying somebody's tax bill for them through the county. The county keeps the record, and then they say to the people, okay, if you want to stay in your house, you have so many months or a year or 2 years, they have this set plan. You got to pay back that money plus a really high rate of interest, and you get all that money. It doesn't matter if they've got mortgages outstanding or anything, you get paid first. So that's incredible. You even get paid for an IRS lien. That's what's crazy. So links down below to that, okay? Now, back to CMBSs and what's going on there. Roughly $65 billion in CMBS loans are set to mature by the end of this year, including it's $37 billion worth of hard maturities that have no remaining extension options. Now, there's a company called TREP, and they are tracking 130 loan maturities, which total $5.5 billion in just August alone, including 5 non-performing assets, all of which are office buildings, all right? I'm sure you've heard about the office building debacle, and they are collapsing right now because they just can't sell them. They're not, they're vacant. Just over half of the properties with CMBS debt maturing by the end of this year would need some level of new borrower equity to successfully refinance at today's rate. Now, that company I said, TREP, found in a July analysis that the deepest gaps can be found in interest-only loans, especially on office assets. So think about it. Companies that took out this debt a handful of years ago, before the Federal Reserve started raising rates, they did it with the smallest margin available, which meant they had to run into that interest-only loan program, okay? They weren't even paying off any kind of any bit of the debt at all. These are just interest only. And they figured back then, I know exactly what they're thinking. We can refinance later. We can refinance lower, because that's been the game for pretty much a decade, right? Since the Great Recession, we found that bottom and started picking up. Well, the problem is now the uptick in debt is headed to special servicing, right? That could be a signal that lenders are looking to resolve loans, right? Which in some cases have been on their books for more than a decade and have exercised multiple extension periods. But now they've got to wipe that off because their shareholders are getting upset. They're getting nervous. They're not buying as much of their stock. They're actually selling it, and it's hurting their company. Now, of those companies that have had major extensions, right, and they're out of extensions, now the bank's like going to call this loan due. Many of those those property owners have been pushing back their maturity dates. Like I said earlier, those longer extension, right, in hope for a better rate environment, but now they're facing a hard maturity. Rates are not going down. This crash is moving forward as expected. And lenders might also be more open now to forcing an exit this year. With CRE prices in July up, CRE, commercial real estate, up 5.2% over the past 12 months. And that, information comes from Green Street. With those numbers, you're like, how can a crash be happening if they're up 5.2? Let me tell you how. They're going up on a per square footage basis. And the only properties that are selling nationwide are the cheapest, bestest deals. So the bestest deals. So that's how they're according to that. There's still so many thousands and thousands of commercial real estate properties around the nation that are completely vacant. Those aren't selling, okay? So they're taking those out of the equation and they're showing you the ones that are selling that are the cheapest, and they're up 5.2%. So, you also have to realize too that when these properties are priced, they're priced in a down market, they're priced pretty low, and people are coming in and bidding up the really good deals, the really cheap ones, and that's what's causing that price. So you've got to look at it from the standpoint as an investor. Is now a good time to buy CRE? Absolutely not. Is now a good time to short this market and be in cash, getting ready for better deals like the beginning of next year? Absolutely. Hey, if you want to learn about those tax liens, links to the sale below. It's ending today. Have an awesome day. The Real Estate Ninja is out.